Student loans, well, they're the second largest source of debt in our economy, trailing only mortgages. 44 million people and counting hold, believe it or not, $1.4 trillion worth of student loans. And that's why one entrepreneur got the bright idea to give borrowers a better shot at lower rates and a guiding hand toward being able to manage their debt better.
For 5 years, Alex Kubo put his startup dreams on hold, working at ExxonMobil to pay off roughly $40,000 of student debt.
Ended up going to whatever company could pay me the most amount of money.
Kubo's worked hard to manage his loan situation. Entering business school at Wharton in 2015, he found Common Bond, a private online lender started by Wharton students. He locked in a 5.9% rate on a $70,000 loan.
We save our borrowers on average about $20,000+.
David Klein got the idea to offer lower rates and better service in 2011 as he entered Wharton with loans of about $90,000.
The market itself is pretty broken. High rates, complex process, poor service.
10 years earlier, Klein consolidated his college loans with the federal government at about 2%. But the game changed after 2010 when the government stopped guaranteeing loans by private lenders. 8% rates were common.
If consumers are paying 8% and investors are receiving 2%, there's a lot of room to provide more value to the consumer by lowering their rate, to the investor by increasing their return, and then eke out a modest profit in between.
Klein won't say if Common Bond is profitable, only that it began by making $2.5 million worth of loans to 39 Wharton students in 2012, went national a year later, and now it's doing direct loans and refis for students at more than 2,000 schools.
We have lent over $1 billion to tens of thousands of people.
Margins are improving. Early on, Common Bond paid investors 5% for loan capital. Now it's about half that, but still more than the big banks pay. Klein says Common Bond beats its competition on operating costs, has no bank branches, for example, and its high credit, low-risk customers rarely default. That's partly due to the effort it makes to communicate and keep them on track.
You'd be shocked to realize that over 95% of the people who go through that process, even MBA students, don't know exactly what their monthly payment is going to be.
Oh my God, I don't like this!
Which is why 1,000 high schools are using a new video game, Payback, to simulate college costs. It's the brainchild of financial educator Tim Ranzetta.
You'll see many financial service firms providing financial education. What I think is lacking overall, 1 in 6 high school students graduates with a personal finance course. That, for me, is the biggest issue.
It's an issue Alex Kubo values, too. He's now at the New York startup Burrow, an online furniture retailer, but he traveled to Ghana last year to see how, for each loan it makes, the company is funding a year of study for a student in a developing country.
Building schools, providing opportunity, made me feel a lot better about the fact that I owe these people a lot of money.
Feeling good about a lender? Now that's a new one.
A lot of the big folks out there don't seem to make the connection between treating the customer really well and having a long-term sustainable business model.
Interesting business model. Like a lot of companies these days, Common Bond offers a benefit to help its own employees pay down their student debt, and it's been partnering with other companies looking to do the same.